Love of my life, don't leave me.
Really?
You've broken... What?
I'm busy here. Be quiet.
You're busy?
Yeah.
Oh, aye, on next. Full of busy. Bloody hell. I'll tell you what you're not busy at though.
What's that? You do that to me again, you'll be making your own coffee.
Aye. Hello boys and girls. I'm going to be looking at moving averages before it looks like I'm moving out. And a warm welcome to one and all. And for those of you who have not seen me before, my name is Langers, and I am the overgrown child that is the Scruffy trader. Must be true because it says so right there. And Winky's been doing her job. She made me a coffee. Isn't that nice, sweetheart?
It is nice, yes.
What do you mean it is nice, yes, you sarcastic kid? Never mind, I have to live with her. So what are we doing? Well, I'm putting together a series of little videos called Foundation Trading, and today I'm going to be looking at moving averages. And the idea behind all of these videos is to kind of give you grassroots as to what trading is, because trust me, it's not just X marks the spot, and trading is by no means easy, you know. Right, I'm going to rephrase that. Trading is easy. The hard part is you. It's the psychology side, the mindset, overcoming all your emotions, all of that. But if you go through my videos, I touch on that quite a lot. But you still need to know what you're looking at, and that's where these videos come in. Okay. Now, some of them are public, some of them are for the Scruffy squad, and collectively, you'll be able to kind of make yourself a trading plan and hopefully profit from that plan. So let's have a look. So this is just a normal chart, euro dollar on an hour. And how can a moving average help this? Well, I think first of all you need to understand what a moving average is. Now, moving averages are basically just a line on the chart. So if I pull up a moving average, just there, I'll thicken it up so you can see it. Help if I was on the right one. There you go. That's a 50 moving average. But what does it represent? Really what it's doing is there it is at this moment, it counts back 50 candles and then gives an average of the price. And that's it. So it kind of smooths out the market so you can look at it. And what you'll see at this moment in time is it's trading below that moving average, and it's also come up and been respected by it. In other words, it also acts as dynamic support and resistance. But where did they come from in the first place? Well, the main moving averages you'll come across is a 200, a 50, a 20, a 5, and then an 8. And I know they're cock over, but I'll kind of explain it. It's based on roughly 40 trading weeks of the year, and it comes from stock traders, stocks and shares. Why 40 weeks and not 52? Well, it also takes into account faith holidays, bank holidays, all of this sort of thing. And it is a barometer of time that can easily be broken down. So 40 became kind of the default figure to smooth out the year. Okay, so it's a 40-week year. The 50 is the quarter year. In other words, quarter of the 200. There are roughly 20 working days within a month. So that is the 20-day moving average. There are 5 working days within a week, Monday through Friday. So that is your 5. And then you have the wild card, 8. Why 8? Because 8 is normally 8 working hours. So one day has 8 working hours within it, roughly. Now some people use different variations. There's a lot of people like Fibonacci numbers. So you may often see, say, 55, which is the true Fibonacci middle line. 34, 21, 89. They're all Fibonacci numbers. But what do they represent? Well, ultimately, they don't make a difference what you use. What you're trying to do is gauge where the market is at what you're looking at a given time. So they really are just a barometer of buy or sell. If it is above a certain moving average, you're going to buy it. If it is below, you're going to sell it. But you can also use them as target points. And why a target point? Well, case in point here, as we are looking. It is broken down, so you could have been selling at this point, but if you decide you're going to buy, it is reasonable to assume that this moving average is going to be respected. Up it goes and it touches it. It's broken across the top. It respected it over and over. It broke down. It came back to it. Respected. Broke. When it pulled away, it will come back to it. When it pulled away, it will come back to it. And it doesn't matter what moving average you put on the screen, they will all react the same way. It is just a point of reference, not a definitive. And that's kind of why the moving average cross system doesn't work on low time frames. On a high time frame, if you have a movement like this, the pip count is massive just because it's on a daily. You know, so if you have all of those candles as daily, that would be a substantial move. Whereas that on a 5-minute candle or a 5-minute chart might only be a few pips. So you get caught up in the noise with moving averages. And then you've also got to be able to understand when and why to use one. If you're using it as a trigger, they are perfect in a trend. Case in point, that is trending out. In other words, that is rocketing up. It's crossed, it stays above the moving average for quite a while. So even if you're going to be giving money back, your exit point of here would still have given you a decent amount of money from down here where it crossed. That is a good gap, but where it falls down is the amount of money that you do give back. So this bit here pays you, but you're giving nearly half of your funds back. It's because they're lagging. They take time to play out. Now in the next video, I'm going to show you how you can use moving averages not to just recognize trends and understand what's going on with the chart, but also how to profit from it and not give as much money back. And that'll be in the next video. So let's have a little look at the differences, because the next question is, well, I've seen exponential moving average and I've seen a standard moving average. What's the difference? Not a great deal, to be honest. Again, we'll just drop on an exponential and we'll just leave it on a 50, just the same as the standard, so you can see it. They do flare out, as you can see. All right, and they chop around a little bit, but they're actually still following each other quite well. So what is the difference between them? Well, it's actually case in point, it's showing you right here what the difference is. An exponential adds a little bit of weight to the last part of the candle count. So if you're looking at your 20, it's kind of the last 10-15%. I'm not quite sure on the exact number, but it's the last part of the candle count. So if you're starting here at 50, it's kind of looking at this section here. And as you can see, what it's doing is it's speeding up in the direction that the candles are moving, whereas this is a little bit slow, so it reacts that little bit faster to let you know that there's a change, and that's it. But because you're only using them to get a gauge, it doesn't really matter which one you use. And likewise, when you're watching a lot of videos and they talk about moving average crosses and one thing and another, they say, oh, I've got this amazing moving average cross. If you set it at 48 and not 50, it'll just make that difference and get you in. Well, let's put that to the test as well, shall we? I'll just use it on the moving average, on a standard moving average. We're going to change that to 48. I'll make it red so you can see what the difference is. It's neither here nor there. You would enter it virtually the same point. So what that is, that's just sales guff. Just doesn't mean anything. When you're using moving averages, look at what the big boys are looking at. That's a 200, a 50, a 20, and a 5 and an 8. They're what the big boys look at.
No way!
But ultimately, all they are is just, if it's above, buy it. If it's below, sell it. And that's about as simple as a moving average can be. And what they will do is give you a rough eye shot very quickly as to whether the market is moving. And why is that? Well, it's as simple as it gets. I'll just drop this back. Switch that off. You come into your market today on there. That is bending up horrifically. Well, it's shooting up. That is flattening out. Well, it's gone sideways. This is starting to bend down. It's gone down. It's that simple. It's just a very quick eye shot to see which way the market's moving. And then you need to be starting to look at your levels to see if it's close to a level. You need to start looking at your certain indicators to give you an idea of whether the market is overstretched, whether it's just in play. In other words, it's just doing its normal sort of chugging along. All of these different factors to give you a reason as to enter. But to enter on a moving average, just because it's one's crossed another, it's pretty dangerous. The only time that really works is on a daily, and you're looking at something like a 20 crossing a 50. I'll show you. Just take this out. This is kind of for a swing trade. So you can have, say, a 20 cross a 50. As you can see, it enters here. You would hold that till it goes there, and you'd get, well, actually you don't get a great deal, to be honest. Let's have a look. So where would you get in? You would get in here and you would exit there. So that will give you 30 pips for all of that. But if I was day trading, well, you would see me do 30 pips. Boom, 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 boom. So it's kind of a good example as to why it doesn't always work. But if you were to get in, say, here, and you got out on where it crossed down there, that is 65 pips. Now in the next video, I'll kind of show you how you can get more pips out of it than, well, certainly that. If you're looking for a good moving average cross, if you change that to a 200, now this changes the dynamic a little bit. What you're now looking at is a 50 coming below the 200. That would have lost you money. That would have been going above. That would have lost you money. Get in here. So your entry point will be there. Just there. This is what's called a golden cross. You would still be in that trade now. it's currently been down as far as 336 pips, which would have easily paid off those 2 losses. Now, the case in point, just crunch this up, show you how a golden cross can actually give you a good amount of money. A 50 above a 200 is a golden cross. 50 below the 200 is called a death cross. If you got in, it would be, there's the cross, there's the close, so you would get in down there on that candle, which would be approximately here. Just to give you an example, and you hold it till it crosses back in. So the candle that closed on that cross would be that one, and it closed there. That is 746 pips. But how long did it take to do it? Well, there's the cross, and there's the other cross. Took it 294 days just to get 753. So how do I put this? Moving averages are good to give you an idea of what the market is doing, but as a system, moving average cross, and there are plenty being sold out there, it's not great. It's not good at all. Anyway, something for you to think about, and in the next one I'm going to show you how you can get more pips out of this using just a moving average, and then I'll put it into practice on Friday. So there we go, simple stuff. So as always guys, trade well, keep your risk managed, but above all, do what you love and the money will follow. See you all in the next one.